We're pleased to be doing this topic today and pleased to have our speaker, Mike Pappas from Barnes Wendling CPAs. It's a local CPA firm here in Northeast Ohio. They have a couple different, I think 3 or 4 offices. Mike, anything I say about you or your company, you can feel free to correct me if I'm wrong, but Mike's been working with us on the succession planning program here in Northeast Ohio for a while now, and we're pleased to have him today, and I think without further ado, I'm going to pass it on over to him.
Thank you, Chris. Good morning and welcome to everybody. I appreciate the opportunity to address everyone this morning about the management succession plan. In that, there's many different forms succession planning can take. Some of the more common ones involve, third-party sales of an enterprise to strategic buyers, to investment individuals or private equity firms. Some organizations can pursue a roll-up strategy. Some also can pursue an ESOP strategy. Others look to maybe even taking a company public. Others look to succeeding the business to the family. And here we're to talk about management succession plan. Probably of all the succession planning that needs to be addressed is the management succession plan, because we're really not certain which other direction a company will go when they're looking to sell or succeed the business to another owner or to the next generation. But the management succession plan allows a lot of different attributes to stay in place, in that you can maintain continuity of a business. It allows the owner or seller a tremendous amount of flexibility in that they can pull the trigger on the ultimate succession or sale of their business when they choose. You usually can negotiate your own price because the internal management has a little bit better feel for working in the day-to-day operations of the business. So therefore, you can control that process better. You can have lower transaction costs involved with it, and the timing of the cash flows and the related taxes can also be set as a part of this process. But in dealing with the overall strategy of the business investment for the privately held business and the owner of that business really needs to be looked at first and foremost, and that is, this is a business investment just like any other investment, and the ultimate objective of the business investment is to sell it for the highest and best value. Whether you choose to do so or not is up to the individual owner themselves. Our studies have shown that 40 to 60% of an individual owner net worth is tied up in their business, and the better that they plan for the orderly succession of that business typically can command a higher dollar amount. So it's usually in their best interest to Chris, there was a message that came up from somebody having a dial-in issue. Just sharing that with you.
No, I was just sending out a message to one of our participants who is on the web portion but hasn't dialed into the telephone. So
okay.
I just sent it to them to see how they were doing.
Okay, great.
All right.
But first and foremost, the management succession plan really is more important than anything, and actually should be looked upon from the very beginning as to whether or not you choose to succeed at the management. You should always have a plan that management succession will be in place to accomplish the overall long-term objective, because it puts an orderly structure in place.
Okay. There's what he's talking about.
Okay, next. How many miracles for you now?
Do we have another person in?
Yeah, I guess you'd say that.
Okay, you might want to put your phone on, your own personal phone on mute.
Okay.
Because we're hearing what's going on in your office right now.
Okay.
Okay, let's go back to the beginning. Before you begin the process of selling your business, there are a number of issues that really need to be considered. First and foremost, you must ask yourself what aspects of the sale are most important to you. And this is different for everybody. Some people are specifically looking at, what the ultimate amount of cash they're going to derive from the sale, whether or not they're going to finance some of this purchase price themselves, sometimes in a management succession plan. And in today's economic times, you may not be able to get as much external financing as you would like, so the owner in and of itself may need to finance some of this for the management team to make it an orderly transition. It's not unusual in a closely held business that there's many family members involved in the business, and if you want to have some of those family members still remain or be involved in the business, typically you may have to enter into some type of contractual arrangement so that management will keep some of those family members in place. In many of these situations, we're often talking with our clientele regarding key employees. It's not unusual that there's been some long-time loyal employees that have been with the business, and sometimes it's important for those people to be protected throughout this management succession plan. Tax advantages are extremely important to everybody in dealing with this, largely because different structures of the transaction can yield different tax effects. Sometimes you can get a tax advantage, which will basically lower the purchase price for those. And more importantly, is there a minimum price? Usually, if the purchase price cannot be achieved, then the deal will fall apart. So you need to assess at the very beginning some of these key attributes because they do have a long-term and effect on the overall strategy. Next, if you don't have a particular price in mind, we need to establish the value. And the classic definition of the market value is the price at which a transaction occurs between a willing buyer and willing seller, neither being under compulsion to buy or sell, and both having reasonable knowledge of the relevant facts. That is the classic definition for a market sale. So the question usually comes about, do you need a business valuation? Sometimes this will help substantiate a price to the management team that you're looking to sell the business to. So it doesn't hurt to invest in a business valuation to help support the overlying price on which you're trying to derive. In other types of situations, a valuation is not required, but can certainly help add more credibility to an independent third party. People usually ask what the prices of valuations are, and they will range anywhere from $7,000 to $15,000 so you kind of get an idea what some of the investment costs are involved with establishing value. One of the most important jobs that the owner has to deal with is the company ready. How do we prepare for the company and a management succession plan? You have to take a step back when evaluating your management team to determine if they're really the right people to take this business and purchase it from the owner. And that can be very challenging at times because different components of your management team may have different attributes and different talents. And you really need to be objective in evaluating their abilities and their talents in order to make sure that you have the right people in place. And you have to be objective in that if you don't have the right people in place, that you need to take a step back and determine which would be the right people. Some of these are generational issues. Some of these other issues just have to deal with pure expertise. Other issues have to deal with overall management ability. It's not unusual that an owner of a business typically will evaluate the business from their perspective in that the business cannot survive without me. And if that's truly the conclusion you're coming back with, then you're going to need to think hard about how you evaluate your people to find someone that can actually replace you in the business. Let's see here. Here we go. Next slide. And this really leads to what we refer to as this inverse relationship. The less important the owner is to the day-to-day business operations, the more value it creates. If the business centers totally around the business owner, then the likelihood of a successful management succession plan being put in place is reduced and the value declines. So the less the business it revolves around the business owner, the greater the value of that business. 4 steps to a successful management plan is 1, establish the vision. You really need to sit back and figure out what you want to do and when. And that's a timing issue. Meaning if you want to sell the business in 5 years or 10 years, then you have to start working on this plan now. And 5 years is probably a little bit too late from a management succession standpoint, because you need time to develop the personnel and assess their skills. And the best way to achieve it. I mean, sometimes you're going to have to assess some of the management team's abilities and sit back and establish a training plan for them. Many organizations, especially privately held, don't invest as much in formal training programs, and those formal training programs can be external as well as internal on-the-job training. But as far as from a skills standpoint and development of those skills, a formalized training program would go a long way to help accomplish the long-term plan for management succession. Whether or not you choose to operate with a formal management succession plan or not, or if you decide to sell it to a third party, which a lot of people look at, having a strong management succession plan in place will increase the value regardless of who you ultimately decide to sell it to. The key thing about the plan all along is you must have a plan, and you really need to have it in writing. The more successful the plans are those that are committed to writing, and that way you can measure the results periodically against the plan you've written down in order to make sure that you're still on track. The hardest thing, actually, once you're committed to a plan, is implementing it and truly executing it. Establish the vision. What is it you want to accomplish? And this takes many forms. It can be a certain dollar value. It could be a certain time frame. It could be a combination of both. This will help determine the best vehicle in order to get there. If you don't know where you want to go, then any road will get you there. And it's very important to have a vision on where you want to end up so that we can work on getting the specifics in place to accomplish that. The assessment. What's the reality check? Independently, an operational management succession feasibility study can assist, and this is where you could potentially engage some outside advisor professional to come in and assess your operations, and simultaneously the management team in place that is working with each discipline of the company to accomplish the overall objective. It just coincidentally, I was working last week with a client on a management succession plan and evaluating their lack of strategy for growing their business. And at the end of the day, the conclusion was that we needed to do some reorganizational matters of their internal personnel, and simultaneously with that, we developed a very succinct timeline for certain people to get certain training to succeed certain executive management that was in place that are nearing retirement. Unfortunately, the existing management team did not really look far enough beyond that first layer of executive management to determine who was going to succeed them in their management positions. The end result was a very good one in that they really assessed their individual strengths and weaknesses of their entire team, the ages of their entire team, to determine how much time they need to have additional training, internal as well as external, in order to develop them to succeed these retiring executives. And so the importance of drilling down into a couple of layers of your personnel and of your team will help you accomplish a strong executive management succession plan, which once again ultimately creates higher value for the business.
Mike?
Yes.
Quick question. How long of a process is that usually, that feasibility study type check on the management? Is it does it take a week? Does it take a month? Does it take 6 months? Kind of thing.
Typically, you can do a reasonable assessment in 2 to 4 weeks, and it's not full time 2 to 4 weeks, but over a 2 to 4 week period of time, you can get a pretty good assessment.
Okay, great. Thank you.
The next step is the plan. Without question, it just doesn't happen because someone has it embodied in their mind that they're going to work toward a specific objective of management succession plan without actually having a formalized plan. So the more specific one is with having concrete steps, the better it will be. And then the real key to success is once you have this plan in place is for the owner or entrepreneur to begin to let go. And that is usually very challenging because the privately held business that they've grown is their baby. And it's pretty tough to let that go into others' hands that don't necessarily have the same care and nurturing.
Mike?
Yes.
We have a question from a participant. Is succession predicated on the legal structure of the business, for example, not for sole proprietorships?
No, it's not predicated on legal structure at all.
Okay. So a sole proprietorship is still something that you're going to have to work on this for?
Absolutely. Absolutely.
Okay.
Any business should, regardless of legal structure, should be worked on.
Okay, great. Thank you.
The next step is the implementation, and here's where all the action is. You have to keep highly focused on what it is you want to accomplish. If you've laid out specific timelines and objectives for training, education, some organizations have a management succession plan where they will actually rotate their management team to different functions within the business so that they fully understand what goes on in each area of the business, so that they can appreciate the pros and the cons, as well as the successes and the pitfalls associated with each. So you need to continually assess and modify that as necessary, and you need to stay out of the way. That doesn't mean that you totally advocate responsibility, but you need to allow people some latitude in order to have some successes and learn from their failures, and then keep moving in a positive direction. Outcomes, you increase your options with this type of plan and the time to work on them. Incredibly important is the increased value. It's very unusual that individuals won't say that they want to have a smaller or lesser value. Everybody wants to try to get the most value that they possibly can. And when you have a plan and a management succession plan in place to do that, you can accomplish more and achieve a greater value and have greater flexibility because you've spent some time developing the management team to succeed the eventual owner. So having a good management succession plan in place will assist the owner with providing a lot of flexibility, whether or not they choose to sell it to management or pursue some other option. The key is an increased value. The company will continue to prosper and grow without the entrepreneurial founder's ongoing involvement, and that's usually where the long-term benefit results.
Mike, another question.
Yeah.
Are there some strategies that make good management succession planning more important than others? I guess the sense that I'm thinking about is if you're selling to a competitor, they already have a management structure in place, and is it chances are that they're going to install their own management, or are they still looking to keep the present management in some way, shape, or form? Does that make sense?
No, that's a great question. If you have exactly what you were just saying, if you were selling to a competitor, it's not unusual that the competitor will look to duplicating. Rather, they'll look at duplicate positions and they will eliminate the duplicate positions. It's not uncommon that they would look to themselves to replace the executives of the target company with their own people, largely because they have confidence and faith in them. However, a good prospective buyer of a business is going to truly assess the executive management team decision as far as the talent goes, because they're going to look and say, hey, it's very possible that the entity they're acquiring may have better people than the people that are in their own organization. But usually where there is duplication, they will usually try to streamline that down in order to yield a better return on their investment. So a lot of it depends on the strength of those individuals that are in those management positions. Usually executive salespeople typically are retained because they know the customers very well. Operational people that know the production processes or the service processes, those people are usually retained as well because they're very close to the process. It's not unusual that some of the overlap will occur maybe in some of the financial positions. If you have if you have two VPs of finance or two controllers, usually one will be the survivor because it's not unusual for the other controller to be able to take on the additional workload. So it doesn't automatically mean that there's going to be a total wiping out of an executive management level, but usually in the administrative or financial areas is usually where the duplication exists. Does that help?
Great, thanks, Mike.
When you sell to management, the nice thing is your management knows your business. They have a personal stake in it. They've usually been people that have been around for a while, so they begin to take pride in ownership of the systems, procedures, practices, and the success the company has already endured. So they like to see it survive and prosper. Management at times may be willing to pay a little bit more for your company than an outside financial buyer would, because they know the pitfalls within the organization, and they also know where the successes are. The only problem with company insiders frequently is they lack sufficient cash, which usually places a little higher burden on the seller to finance a large part of the transaction. It's not unusual to go outside to a bank or another financial enterprise to see how much you can potentially borrow, or the maximum amount you can borrow on this type of arrangement. And if it falls short, then the owner itself is typically going to have to make up the difference. The flip side is that you know the parties well, so you might be a little bit flexible on your terms. You might be willing to recover part of the sales price in a long-term earn-out provision, maybe a consulting arrangement, or even some type of non-qualified compensation plan. Major pros in a management buyout: usually there's no risk of competition or integration issues, as we talked about in that question that came up. The management team will remain with the business. They know the growth opportunities, they know the experience of the organization, they know the personnel. Integration issues are minor, and there's a tremendous sense of loyalty that exists. The cons of management buyout: it can be perceived as disloyal and suspicious by those that are not involved. If for some reason it's not successful, it can create some internal conflict amongst the management team and or other staff. Sometimes the legal documentation requires a little bit more stringent because there might be family members involved, or in the event that the executive management team the business is failing under their guidance, the owner may have to step back in and take control of the situation in order to preserve the amount that he has been financing. There can be an extensive time frame to execute, and the management team needs to continue operating the company. I mean, the important thing whenever you're going through any type of succession plan is you can't take your eye off the ball. You have to make sure that you're still doing all the blocking and tackling and doing the day-to-day operational issues, and still focused on growing the business and being profitable. because if this lingers on too long, it's not unusual, and unfortunately I've seen it a number of times, where people have taken their eye off the ball and the profitability and direction of the company slips. And it is not unusual that it requires more money than a startup company.
Mike, I thought we'd take a quick pause here. We've got about 15 minutes left, and I'm going to open up the phone lines, and feel free to unclick the mute on your phone if you've gotten. Does anyone have any questions before we move to the next couple slides? Any questions we'd like to bring up for Mike? Okay. Always remember that you can use the chat function just to send a question as well, and I'll interrupt and ask it as I've done in the last couple times. And I guess we'll turn it back to you, Mike.
Thank you, Chris. In order to really make this a success, you really need to work with your professional advisors regardless of strategy. It's not an unusual part of your professional advisor team, your attorney, your accountant, and any other particular business advisor, and maybe for some of those organizations that have business advisory boards or a formal board of directors, it would be worth your while to make sure that you include everybody in these discussions, because the old proverbial two heads are better than one. In this case, 2, 3, or 5 heads are better than one works quite well for accomplishing your overall objective, in that some of these other individuals have been through these succession plans before, and by doing so can help you avoid some of the pitfalls. Specific areas where you require advice from your accountants typically are accounting and reporting, systems and controls. And if you don't have good controls in place, once you go through a management succession plan, you'll need them, because if you're looking to advocate responsibility, you want to make sure that you have good reporting controls to know exactly what's going on in those areas that you've delegated to others. With respect to the business plan, it's really important that you get the entire management team together to draft the plan, project financial results, and it's important that your outside accountant be able to help validate the numbers, make sure that they're correct and on track. In determining the amount and the nature of the consideration, cash flow considerations are very important, as well as the financing structure are important. Typically, your accountant can work with you on those types of issues, can help keep things focused, and make sure that the company can accomplish the financial repayment based on its anticipated cash flows. Because one of the worst things you can have happen is all of a sudden you entered into a deal where the cash flow of the company has declined, and the management team either has to reduce expenses, reduce compensation in order to maintain what it committed to on the purchase price back to the bank and or to the owner that just recently sold. Areas where you require advice from lawyers typically include established on company matters. Sometimes that could be legal structure that was brought up before, whether or not we need to change the legal structure in order to accomplish this. Ascertaining title to property. Even though that you've been operating the business for a while, sometimes things fall through the cracks and the title to property is not as one thinks it is, so you'll need the attorneys to help with that. They will also draft and prepare any specific contracts and agreements. And when we talk about that, contracts and agreements are more than just the actual sale agreement or purchase agreement, but there could also be compensation agreements beyond that for earnouts, non-qualified deferred compensation plans, or some management incentive plans in order to keep the entire management team together. Establishing the sufficiency of and creation of security. That's where we're talking about a security arrangement where, especially if the owner is selling some of the business and has to take back some financing in order to make this thing fly, then basically the owner has all his eggs in one basket. he may have received some cash off the table, but now also has to put some controls in place to make sure that if things start going astray, that he has some security for the remainder of the loan that is outstanding to him. Employment matters become very important in that you don't want to lose other key employees that help make the business successful, so you want to make sure these employment matters are taken care of as well. Often overlooked is the protection of intellectual property. In this day and age, more and more businesses have a tremendous investment in intellectual property, and it is very important to make sure that the intellectual property rights are protected and preserved for the enterprise, so that those that are making the investment to acquire it are protected as far as the income stream goes after the sale. And even more importantly, working together with your professional advisors is important, but it is really essential that you get your lawyer and accountant and other team members together to help support the management team and making sure that there's a smooth transition of power. There are times where there are areas where the lawyers and accountants' roles will overlap, but you can easily clarify these early on in the developmental process. If your ultimate plan or goal is to have a succession plan, it is really worthwhile to get these advisors involved in the process early on so that they can help develop a plan for you and so that you can successfully implement it. One of the worst things that can happen is for a owner to think 5 or 10 years out that it wants to start developing a plan, and you really need to start. It's a continuous process that needs to be worked out from the onset of the inception of the business. So it's really important to let your advisors know what your ultimate plan is for the business. Whether or not you know that definitively or not almost doesn't matter, but planning for contingencies is the most important thing you can do. So getting those to work together as a sounding board on the business plan should really help. Other things that typically occur are tax warranties or indemnifications, employee, talk about share schemes and pension arrangements, and the finance documents themselves. Those are all things that are incredibly important when working through with your professional advisors.
Mike?
Yes.
We have a couple questions, and I looked at the questions and I have a couple follow-ups if that's okay. First question is from how would you recommend a business owner find good advisors? What are things to look for?
When you're going through the process of looking for advisors, I would develop a very specific list of interview questions, very pointed to not only their creativity but also their flexibility. The worst thing you can do is get an advisor who is pretty much looking at things only one direction, and meaning is they often look at the best thing to do as far as succeeding a business is to sell it to a third party. And you really need someone who's very open-minded and listening to your goals and objectives as far as helping you accomplish those goals and objectives, regardless of their own personal goals and objectives. So I would, like any other interview, I would craft a very detailed list of specific questions and ask these questions of different advisors in order to determine those that will help best accomplish your goals and objectives. I would also, if you have a lot of time to work on this, I would work with other professionals and ask them for their recommendations. Not uncommon to find out and do a little due diligence on the background of those individuals that can help. Once you're interviewing those individuals, I would ask them for references on people they've helped work through these processes, and make sure that there's a sufficient number of those to call in order to gain a good comfort level on the references that they've provided you. Because you really want to make sure, because there are advisors, like anything, there's good and bad advisors out there. Some advisors will help will help work toward a succession plan, and and it's not unusual that people starting early on may not have enough cash to afford their advisor fees, and sometimes the advisors will often take the proverbial piece of the action. Maybe they want a percentage of the transaction cost, or maybe they want a success fee, or maybe they want an equity stake in the business. And it's important for you to understand if those things are okay for you. Once those advisors, what I'll say, have a stake in the game, so to speak, then you have to wonder how independent they are in their decision making to advise you accordingly. So you want to make sure that everybody's doing what's best for you and not necessarily what's best for them.
Makes sense. My own follow-up would be, we get this question a lot. Would you recommend, we generally recommend to business owners that they hire specialists to do the actual transaction work, just, based on the assumption that, if you need surgery, you don't go to your general practitioner, doctor. Yeah. Would you agree with that, disagree, or what do you think?
I think some of it has to do with facts and circumstances. I can tell you that there have been times where I've recommended to clients that they need to seek someone independent to help them with this process, largely because the dynamics that I would be involved in as an advisor to them would not work well. You know what I'm saying? And as you said, it's difficult sometimes to be all things to all people. There are other times that the team that you're working with, trust their existing advisors implicitly. And as long as they feel comfortable with the skills their advisor has, it's okay to leave them in place as long as they're not just dabbling and they've actually helped structure these transactions. As long as they have background structuring these transactions, there's nothing wrong with doing that. But to your point, Chris, I wouldn't blindly just assume because they've been an advisor yours for a long time that they know how to do this. That would be a mistake. I would truly assess their capabilities for helping you do that. So a lot of it, and like anything, sometimes you work with an advisor who's helped you with certain financial matters throughout or certain legal matters throughout, and you've never asked them if they've ever been involved in these succession plans or these types of transactions, and the fact is they may have been involved with these. It's just that since they were never involved with it with your organization, you never thought to ask them the question. Right. Like anything, I would just do the appropriate due diligence to make sure that you feel comfortable with your advisor. Okay, makes sense. The second question is, how often should one revisit their management succession plan? If you're working a plan, I would say annually at least. There might be some facts and circumstances that occur during the year that may necessitate the change, meaning you have a turnover of personnel or you have a tremendous expansion in your business or something along that line. But at least annually is a sufficient time to help evaluate and reevaluate the plan. Okay, well, you, in the process of answering the first question, you answered my follow-up question. So that's good. I think, should we just keep on going, Mike, or are we towards the end here? Actually, the next slide was questions, so okay. Chris, you did a good job by bringing that point up. If there's other questions that other people have, I would certainly entertain them. I'm going to take a couple quick seconds here. Please, if you've muted your own personal phone line, please feel free to unmute and ask a question if you want. All the phone lines are open from the perspective of the conference call. So quickly here, does anyone have any other questions for Mike?
I'd like to hear, this is Mel, I'd like to hear a little bit more on the issue of intellectual property and licensing of such. Not knowing anything about your specific business, in this day and age, there's a tremendous amount of intellectual property that has been developed internally with an organization, which helps generate, revenue, cash flow, profit stream, what have you. And it is really important that you get together with appropriate legal advisor to assess the intellectual property that the business in and of itself has in order to preserve its integrity, so that to another buyer, that when they're buying an organization, they want to make sure that the income and cash flow stream that has existed in the past will still be retained and ongoing in the future. So some of those intellectual properties are more difficult to ascertain than others, but that why bringing the appropriate legal advisor in place can help sort out that and protect it for you.
So
Does that help?
basically, you would need an attorney with intellectual property experience rather than general counsel.
Yeah, I would suggest that.
Thank you.
You're welcome.
I'm sorry, was there another question? Would it be helpful for folks if I turned off the recording to ask a question that you may not want recorded? I'm more than happy to do so. Any other questions then? Okay, Mike, did you have any other closing comments you'd like to make?
That's it for now. The overriding factor in a succession plan truly is the commitment. Be realistic in your objectives and the ultimate goal that you want to achieve. Begin to put that plan down in paper, and don't expect that as the business owner that you should draft that alone. I would definitely encourage working with outside advisors on that. Like most of the clients that are entrepreneurial in nature, they are very good at their business and developing either the products or services that they went into business for. And I have not found any 360-degree people yet out there that are good at everything. So I would bring in the appropriate advisors to help work on your management succession plan, at least the key elements of it now, of which you could execute and implement on a timely basis and revisit at least annually.
Great. I would second those comments, and again, I really fully believe that management succession, how you're going to transfer not just ownership, but the managing of the company, the running of the company on a daily basis, is probably one of the most important things you could do when you're going through the process. I want to thank Mike for an excellent presentation. I have Mike's contact info up there on that slide, so you can feel free to contact Mike if you have any further questions. My experience with Mike is he's one of the nicest guys in the business, so I'm sure he'd be happy to talk with you.